Now, a couple of weeks ago, SpaceX launched the largest IPO ever. That's $75 billion raised in a single IPO. And the stock opened at $150 on the open market. Then it surged to $225 by day 4. And that's a 67% gain. Now, Elon Musk became the world's first trillionaire. Now, $1 trillion, one man, that's bigger than most countries' GDPs. Millions of retail investors piled in through various platforms. And then guess what? It started falling. Firstly by 5%, then 3.5%, and then 16% in one day. Now, most open market buyers would have lost nearly all their gains. But one number never changed, which was the 82% voting control that Elon still maintained in SpaceX. Now, before the IPO, he had 82%. After the IPO, 82%. After the stocks crashed, he still maintained 82% voting control. Now, the stock market price moved, but his control never did. I was one of those retail investors that bought in as well. So then I started thinking to myself, what did we retail investors actually buy? So I started looking into this and realized how SpaceX actually structures this. So they have two classes of shares. Class A being what's available to the public, which has 1 vote for every share. And Class B, which is what Musk and insiders have, then they have 10 votes for every share. So while Musk owns 42% economically, he actually controls 82% of voting rights. So what does that mean? That means every major decision, from acquisitions to the strategy to who's on the board, Musk decides their fate. And then I realized something, which is that this is actually not a unique situation. Take Meta, for example. Mark Zuckerberg owns 13%, but he has 61% voting control. Now, some companies don't do this, like Amazon, Apple, Microsoft, Nvidia, all have single class shares proportional to the ownership. But there's a unique pattern to this, which is that founders' vision companies often separate control from the capital. So this is the part that no one actually talks about, which is that the same founders actually control our perception of what their company is worth through their own social media platforms. Now, Musk owns X, Zuckerberg owns Meta, Instagram, WhatsApp. And the hype is amplified through these social media platforms that the founders own. Now, this becomes a situation where the system actually feeds itself. So excitement is generated when they are looking to do a big deal or have an IPO. But in reality, the architecture isn't neutral. Now, when I first started looking into this, my instincts was the same as most people. Now, maybe this is just how public markets work. Companies naturally go public, prices move, some people make money, and some people lose money, right? And that's just the game. And there's a truth in that. Markets always have been volatile. IPOs have always been quite risky. Nobody's forcing anyone to buy. But the more I looked into the specifics, the harder it is to actually dismiss. Now, SpaceX priced its IPO at $135. At a price, the company was valued at $1.77 trillion. Now, Morningstar, one of the most respected research firms in financial markets, published their analysis, and their fair value estimate for SpaceX was $63 per share. That's less than half the IPO price. And that estimate already assumes favorable outcomes for technologies that haven't been proven yet. Now, the company lost $4.9 billion in 2025. And in 2026 alone, in the first quarter, they lost another $4.28 billion. The AI division, which is where most of the valuation narrative lives, every single one of its 11 co-founders have left the company before the IPO. Now, Musk himself said publicly that XAI, the AI company that he merged into SpaceX right before the listing, wasn't built right the first time. And yet, within days of going public, SpaceX announced a $60 billion acquisition, paid for in stock. The same stock that retail investors had just bought at $135. Then they announced a $20 billion bond offering. Now, a company that just raised $75 billion, immediately spending another $60 billion and borrowing $20 billion more. And the people who funded the $75 billion had no vote on any of it. And meanwhile, the stock went from $225 to below $160 in a matter of days. The average open market buyer was underwater. The $1 trillion headline was already fading, but Musk's voting control, still 82%. And that's when I stopped thinking about this as a stock market story, because I started recognizing something different. This is not a one-off event. There's a pattern, one that's been running a lot longer than any of has been alive. What I started realizing is that this isn't a SpaceX story. There's a pattern to this, and it's actually 300 years old. In 1720, the South Sea Company promised trade with South America. Even the king himself endorsed it. The stock rose from £128 to over 1,000 in less than a year. The hype was engineered. Rumors spread like wildfire through coffee houses. The company lent money to people to buy its own stock. An insider traded on information that the public didn't have. And then guess what? It collapsed. 80+% loss. Isaac Newton lost an equivalent of £268 million. Thousands of families' lives were ruined, and Parliament stripped the directors of their wealth after the damage was already done. In 2017, Snapchat went public and sold shares with zero voting rights. None. The stock surged 41% on day one, and by the end of 2018, it was below $5. That's an 80% loss. $10 billion in the market value gone. And what happened to the founder? The founder's control was untouched because the public never had any to begin with. In 2019, WeWork was valued at $47 billion. Adam Newman held super voting shares and used the company like a personal fund. The valuation collapsed, the IPO was pulled, but Newman walked away with $1.7 billion. SoftBank lost $11 billion, and the employees, the people who actually built the company, their stock options went to zero. Not reduced, zero. Newman is again raising money for another startup, while these employees got nothing. Now in 2026, SpaceX, $75 billion raise, 82% control return. Stock surge, then crash. Morningstar values it at less than half of what investors paid. Same structure, same outcome. Now 4 stories across 3 centuries. Every time the public funds the vision, then they absorb the loss and walk away with nothing, while the founder retained control and walk away with wealth intact. The only thing that's changed is this. The South Sea Company directors didn't control the coffee houses where the hype was spread. Today's founders control X, Meta, Instagram, WhatsApp, the platforms that shape what people believe, what people buy, and what people invest in. The hype that pulls capital in is amplified through infrastructure the founders themselves own. Now, this is not a conspiracy, it's a system. It's 300 years old, but it just never had social media amplification before. So what do we do with all this information? Because this pattern isn't just playing out in the stock market, right? It's playing out everywhere, right now. The same founders who control these capital structures are also building AI systems that are reshaping the economy. Musk merged XAI into SpaceX right before the IPO. Now Zuckerberg is pouring billions into Meta AI. Google is rebuilding every product around Gemini. The company that controls your capital will also control the technology that's replacing your job, rewriting your industry and redefining what humans' work is worth. And people can feel that. The economy feels uncertain. Jobs are disappearing, not slowly, but very visibly. The value of human service, the one thing that most people have built their entire lives around, feels like it's dropping. Business momentum is harder to find. Everything feels like it's shifting underneath you, and nobody can tell you where it's going. And in that environment, the instinct is to look for someone who has the answer. Follow the hype, follow the trend, follow the person who seems to know where things are heading. But that's the trap. That's the same trap it's always been. South Sea Company investors followed the coffee houses. The Snapchat investors followed the IPO excitement. The WeWork employees followed Adam Newman's vision. And now millions of people are following AI headlines, crypto narratives, and trillion-dollar IPOs, looking for someone else's version of where the future is going. And every time, the person who followed someone else's narrative absorbed the consequences when it shifts. Now, I've lived through a version of this myself. When Google suspended our mattress business overnight, I thought the lesson was about platform control. The real lesson was actually simpler than that. We had built everything on one channel, one source of traffic, one version of the truth. Now, when that single source shut down, we had nothing underneath. Single source dependency, whether it's a stock, a platform, or a job, an industry, or even a belief about how you think the world works. The moment you stop questioning it and treat it as the only source of truth, you made yourself very fragile. The opposite of that fragility isn't some grand strategy. It's actually your own curiosity. When we built Zua, our e-commerce business, every supplier said no. The industry said consumers wouldn't buy renovation products. But we had no validation, no hype, no external narrative telling us it would work. But we stayed the course. We just stayed curious. Learned Shopify, learned marketing, tracked every algorithm change. adapted every time something shifted, built our relationships one at a time. And years later, when COVID moved the entire market online, we were already there. Not because we predicted it, because we had been learning the whole time. That's compound curiosity. And it's the only thing that I found that actually holds up in the long run. Whether markets crash or platforms shut you down or AI rewrites your entire industry overnight. Because here's one thing that AI can't replicate. It can't replicate the supplier relationships you built over 10 years by showing up and delivering. It can't replicate the operational instinct you developed by failing across multiple different types of businesses. It can't replicate the judgment you earned by learning things the hard way, across different industries, different problems, different seasons. Now, AI can process information a lot faster than any human. But one thing it can't do is compound your experience. It can't compound trust. It can't compound the kind of understanding that only comes from being in it, from doing the work, making the mistakes, and learning what's actually true versus what sounds true. And that's the real divide that's currently emerging. Not between people who use AI and people who don't, but between people who are building their own source of truth through their own curiosity, through their own experience, through the compound journey, and people who are outsourcing the understanding to whatever narrative is loudest. The stock market has always rewarded the people who control the structure over the people who follow the hype. Now, AI will do the same thing. The people who build with it, who understand it deeply, who stays curious about what it actually means, they will compound. The people who just react to the headlines, oh, AI is taking all the jobs, AI will make everyone rich, they'll absorb the volatility of someone else's narrative again. So the question isn't whether AI is coming, it's already here. The question isn't whether the economy is shifting, it is. The question is, are you building your understanding from someone else's hype, or are you using your own curiosity? In the warehouse, in a supplier call, in the algorithm change you stayed up learning, in the problem you solved that nobody else even noticed, or on a Tuesday night when nobody's watching.